Hey everybody, this is Pat Jennings from thebizseller.com, and this is the third video in our series on business valuation basics. Now, in the first two videos, we established that your company's earnings, as opposed to your sales or some type of rule of thumb, that your earnings must be the basis for your valuation when you go to price your business, and that for small owner-managed businesses, it's the owner's benefit figure that should be the definition of earnings that we use when we price our business. And just as a quick review, the owner's benefit is the sum of your company's most recent annual pre-tax profits, your salary, all of the perks and benefits that go to you and your family's, for your family's benefit, any of your interest payments, and depreciation. Now, the multiple of earnings method is one of the simpler ways to value a business. You simply take that owner's benefit number and multiply it by a number called the multiple to arrive at your asking price. And the multiple can be viewed as a return on investment for the buyer. So it shouldn't be something that is just randomly picked out of thin air, although some people seem to think that that's what it is. That's why they don't understand or trust the multiple of earnings method. But let's look at a couple examples of two different types of businesses and see how this works. Let's take a business that has $100,000 in owner's benefit in its most recent year. And let's say that that business has a lot going for it. A solid customer base, good reputation. It has a good lease that's in place for the next few years. It has little competition. If the owner went to sell that business for $300,000, meaning a multiple of 3, which for smaller owner-managed businesses, and by small I mean definitely below $1 million in sales, and most businesses in this category would have less than $500,000 in sales, but a multiple of 3 for a business of that size where the owner also manages it on a daily basis, a multiple of 3 is very good. So that would mean that a buyer of this business, if they took over the business and ran it for a year, and they too made $100,000 in owner's benefit that first year, that would be a 33% return on their investment, assuming that everything stayed the same. The buyer invests $300,000 up front. 1 year later, they've made $100,000, and they still have a business that's going to be worth about $300,000. So that's a pretty good return on their investment. Now let's look at a different business that maybe isn't as solid. The future earnings may not be as so certain. The buyer in this case would be taking on more risk. Maybe the customer base isn't as large, or there isn't as much repeat business. There's more competition. The lease is about to expire in 6 months. Well, the buyer of that business is obviously going to be taking on more risk and uncertainty than the business in number 2. So even though it has the same owner's benefit of $100,000, a business like this might get closer to a multiple of 2. So the person buys this business, they run it for a year, nothing changes, they make $100,000, they've made a 50% return on their investment. The less stable, the less attractive the business, the higher the return on the investment a buyer will demand, and therefore the lower multiple that the seller can demand. So that is really what the multiple is a reflection of, is the return on investment that the buyer is looking for with the money they spend to buy the business. These may seem like unusually high returns for the buyer, and if you compare them to the stock market, they are. But remember, the typical multiples we talk about, and they're about 2 to 2.5 for an owner-managed small business. Well, the buyer of that business is going to come in each day and work the business in order to get that type of return. So comparing the purchase of a business to real estate or a stock investment really is an apples to orange comparison. Now, this brings up a big problem that I see a lot of, not a big problem, but a big misconception that I see with small business owners when they go out onto the internet to try to do research about selling their business and about pricing their business. And mostly what you come across on the internet is geared toward larger businesses, When you read about mergers and acquisitions or what are called mid-market companies, mid-market refers to companies with 10, 20, $50 million in sales. And every day I come across these comments on blogs or discussion groups about how such and such a business could easily sell for 6 times or 8 times its earnings. Well, it's never easy to sell a business for 8 times its earnings, but it does happen with companies in that size category. But that's because they're being bought by bigger companies that have lots of resources and can take that company and grow it exponentially. But when we're talking about owner-managed businesses, where the owner comes in and works it every day, a restaurant, a retail shop, a gift shop, a hair salon, a dry cleaners, we're not historically looking at those kinds of multiples. We're looking at about 2 to 2.5. So summing up, the multiple of earnings equation is a representation of return on investment. And in very small businesses, buyers expect to get a higher return on their investment because the money they're investing, they're also investing their time, they're putting their time into that business every single day. And so the comparisons to much larger companies don't apply. Now, the next obvious question is, what number do you multiply your owner's benefit figure by to come up with a price range for your business? Well, as you can imagine, there are a lot of factors that can affect your multiple, and instead of going into each and every one of them here, we've posted an article on our site, and there's a link to that article at the very beginning of the description below in the description box. So you can click on that link, go to that article, and read all about the various factors that can increase or decrease your multiple. And then in the next video, we're going to go through some of the more common questions that we've received from business sellers in reference to valuing their business. So I will talk to you then.